Sam, are you surprised that stocks haven't really reacted negatively to the shutdown?
Not really, because if you go back over the last 40 years, we've had more than 20 government shutdowns. The average change from the start to the end has been flat, and the worst performance was in 1979. We were down just about 4%. The best performance is this year. So the market has actually been going up, I think primarily because of the bottom that we reached on December 24th.
But we're now into the longest ever. Does that not hurt the economy moving forward? We've seen various GDP downgrades. That in due course, of course, can affect the market.
Well, I think because the average shutdown has only been 8 days, that the longer we go, we're going into uncharted territory. So absolutely, and with that S&P Global estimate of what, $1.2 billion being shaved off of GDP for every day that's been going on, then that is a concern. But still, I think the focus is primarily on Q4 earnings and 2019 guidance, combined with what the outcome of the trade talks will be.
Yeah, I mean, let's pick up there, Evan. How's the market set up now that we've had this mini rebound, but still more than 10% off the highs for the S&P for earnings season, which really kicks off in earnest next week?
Yeah, that's right. And it makes sense for the market to take a little bit of a breather here. And I really think the earnings are going to be what drives the market over the next few weeks. We've had the Fed pause. That was constructive, or the signaling of the Fed pause. We now have some constructive news on the trade front. Now we actually get into the earnings, and what will be key is the guidance that we get from these companies. So how much are they being affected by softer global growth? How much are rising input costs, rising labor costs weighing on margins and the like? So our focus will be purely on earnings over the next few weeks.
Rick, what's your main takeaway this week for the bond markets? I guess we've seen a slight steepening of the curve. What's been the main driver for that?
I think that the words pause, flexibility lead me to only one conclusion. We are at a temporary neutral rate. And I think if you consider it that way, things line up better. I think the Treasury complex is paying an inordinate amount of attention to what's going on in equities. And as Patty Dahm and some of the research has pointed to at CNBC, we haven't had these big 1% moves. I think that's a good thing, but these markets are still a bit fragile. So in my opinion, thinking about the Fed at a temporary neutral allows the markets and how they digest economic fundamentals when we finally get them released as to lead the Fed as to its next move has given the market much comfort. And I think that's actually a very good thing, not only domestically, but I think with our markets toning down some of their anxieties a bit, my guess is that will be very contagious into the global sphere as well.
So that raises a question, Evan. Where do you want to be right now? In the U.S. market, or overseas? Emerging markets are just coming off the highest level in about a month on this idea Rick's talking about. If the Fed takes a pause or is more patient, it helps them just as much as it helps us.
That's right. We really like emerging markets here. We think the dollar is going to stage a meaningful depreciation this year. It's not just the pause from the Fed, but it's also, we just think, reserve managers around the world, they see the U.S. political uncertainty, and we're seeing them beginning to diversify away from the dollar and into other currencies. So when you have a weaker dollar environment, that's obviously better for emerging markets. And given how hard emerging markets got hit during the bulk of last year, there's really good value to be had there.
Sam, what's the sector you think that's best set up for earnings season?
Well, I think that I wouldn't really call it a particular sector, but a kind of focus would really be on the higher quality issues. Basically looking for those companies that have had good track records of raising earnings and dividends. The reason I say that is because September 30th of this year, of last year, expectations were for fourth quarter earnings to be up 18%. The end of 2018, the expectations were 14%. Now they are in the low 12% area. So it seems as if a lot of people are ratcheting downward their estimates. And financials is an area that really has not seen much of a change. Industrials as well, according to Lindsay Bell from CFRA. So my feeling is those two areas could show the biggest disappointment. So I would focus, if you're looking to add, look to those companies with good quality track records, S&P quality rankings, value side of the equation that have good investment outlooks.
Just want to bring up oil prices, which are down 1.5% right now. Such a tell for the stock. I mean, it feels like stocks and oil right now are connected at the hip. What's with that?
Well, obviously, oil can be a reflection of what investors think is the outlook for the global economy. And with us being below $40 below $50 a barrel for the 2018 period, our expectation is we probably come up to about $55 for all of 2019. So a slight improvement, in a sense, working our way through that supply-demand imbalance. And because we still expect the U.S. economy to be higher, just a little slower than 2018.